ever pondered what the future holds for the world's second-largest economy? Well, the global rating agency, Moody's, has given us some food for thought. Recently, it revised its outlook on China's government credit ratings from stable to negative. This is no small matter as it reflects increasing concerns about the repercussions of surging local government debt and an escalating property crisis. This move underlines the growing evidence that Chinese authorities may need additional financial support for debt-ridden local governments and state-owned enterprises. These pose substantial risks to China's fiscal, economic, and institutional strength. The downgrade is tied to worries about structurally and persistently lower medium-term economic growth and the ongoing contraction of the property sector. Moody's highlighted the heightened risks associated with China's need to navigate these challenges. It's an indication of potential strain on the nation's economic resilience. In the wake of Moody's statement, China's major state-owned banks ramped up US dollar selling, keeping the yuan relatively unchanged by late afternoon. It's also worth noting that since mid-November, the cost of insuring China's sovereign debt against default reached its highest level. While Moody's affirmed China's A1 long-term local and foreign currency issuer ratings, it expressed expectations of a slowdown in China's annual GDP growth to 4.0% in 2024 and 2025, with an average of 3.8% from 2026 to 2030. This outlook adjustment comes ahead of the Central Economic Work Conference, an annual event expected around mid-December. Analysts are already predicting discussions on a steady growth target for 2024 and the potential for additional stimulus. Despite the negative outlook, the A1 rating remains in the investment-grade territory, minimizing the likelihood of forced selling by global funds. Fitch and Standard & Poor's, the other major rating agencies, currently rate China A+ with a stable outlook. China's finance ministry wasn't too thrilled with Moody's decision, expressing confidence in the country's economic rebound and emphasizing that property and local government risks are manageable. But with a deepening property crisis, local government debt concerns, and global economic challenges, China's growth trajectory has hit some turbulence. Despite policy support measures, including interest rate cuts and increased liquidity injections, concerns persist. This has prompted calls for further structural reforms to diversify the economic model and reduce reliance on debt-driven investment. The rising local government debt, which hit 76% of China's economic output in 2022, underscores these economic challenges. In response, China has plans to issue sovereign bonds to stimulate economic activity and has implemented a slightly increased budget deficit target for 2023. Foreign investors have been cautious towards China throughout the year, with capital outflows reaching $75 billion in September, the highest monthly figure since 2016. In conclusion, Moody's decision to revise China's economic outlook from stable to negative is based on concerns about local government debt, the property crisis, and lower medium-term economic growth. This decision will likely have significant implications for China's economic future. However, it's important to remember that despite these concerns, China's A1 rating remains in the investment-grade territory, indicating that, for now, the risks are manageable. But rest assured, the world will be watching closely to see how China navigates these challenges in the coming years.